Hello class. In this particular chapter we're going to talk about monetary policy and the Federal Reserve and how they conduct monetary policy. So the first thing to understand about monetary policy is that it's conducted by the Federal Reserve in the United States, and the Federal Reserve has two goals. Goal number one is what we call price stability, and goal number two is high employment. Now, the Federal Reserve has another set of goals that they also want to have in the economy, but a lot of them are really secondary. Not only that, they tend to kind of happen as well when you have the first two taken care of. So they seem to sort of follow the other two. So as long as you maintain price stability and high employment, the other goals seem to be accessible and able to be produced in the long run. All right. Now, to understand the basic way in which you conduct monetary policy, it is useful to look at the inflation rate in the U.S. in the last, say, 60 years or so. So this right here is inflation in the U.S. in the last 60 years. And as you can see, it wiggles. Notice that zero, by the way, is here. Numbers above zero basically mean that your economy has inflation. Numbers below zero means your economy has deflation. All right. This right here is the federal funds rate in the same time period. Now, the federal funds rate is the target for the majority of the monetary policy by the Federal Reserve. So this is what the Federal Reserve targets when they are changing the money supply. In other words, they change the money supply in order to affect the federal funds rate, which on a previous chapter we said it basically changes all other interest rates. All right, now to understand this one in the most basic way, we need to create something called the money market. The Federal Reserve cannot tell people and companies what to do. So they can't just show up to your business and say, oh, I need you to borrow more money. They can't do that. On the other hand, they can make it extremely cheap for you to borrow money, and then you basically borrow because it is in your interest to do so. So what they basically do is they manipulate the money market in order to make you borrow more or borrow less. Now, this particular way of thinking on how the Federal Reserve manipulates the market was created by John Maynard Keynes way back in the 1930s to explain the money market as well. So it's called the liquidity preference framework. Now, the liquidity preference framework is not the most accurate way of describing the behavior of the Federal Reserve, but it is the simplest way to describe it in the intro to economic classes. All right, so we need to develop what we call the money market model. All right, so what do we have in this particular model? In this particular model, which again we're going to call the money market, we have the quantity of money on this side, and on this side we have interest rates, which is basically the price of money. All right, now we're going to be using lowercase I for interest rates. All right, now we're going to have our supply of money. So we have money supply, and we like to use MS for money supply. And then we're going to have our money demand. And we like to use MD for money demand. Now, the equilibrium between those two generates a particular level of interest rates in the economy. All right, now just like any other supply and demand model, if interest rates were above equilibrium for whatever reason, then they have a tendency to go down because the quantity supply would exceed the quantity demanded, aka there'll be more money available than there is people borrowing money, And then as a consequence of that, interest rates will go down by themselves towards equilibrium. If interest rates were below equilibrium over here, then basically the quantity demanded of money will be more than the quantity supply of money. As a consequence of that shortage in money, interest rates will go up because there'll be a sort of bidding war in the loans available. So we can make the assumption that given the basic behavior of people, equilibrium would eventually happen. All right. So let's talk about who can move what to the right or to the left. So money demand is something that people control. It's something that you and I basically control. And money demand can change for multiple reasons. I don't like to create a full-blown list for this, but in a very basic way, people hold money for multiple reasons. Asset demand, in other words, money is an asset for people. And then transaction demand, in other words, people use money for the purpose of transactions. Things like inflation rates, the level of real GDP, population, rate of return of alternative assets, the amount of liquidity necessary in an economy, the level of output, and the level of wealth, all of can change the level of money demand. But in a very basic way, if there's more money needed in the system, then money demand will shift to the right. For example, when there's more inflation in the system and prices are moving up faster, then there is a necessity for higher amount of money in the system so that it allows you to do those higher price transactions. All right. The money supply is controlled by the Federal Reserve. The Federal Reserve is the entity in charge of either printing or shredding money in the US, and is the entity in charge of also conducting what we call monetary policy. Now, the reason we say that it's a vertical line, it's because in this particular model, we're assuming that the Federal Reserve has full control of the money supply, and they can basically move it to the right or to the left, sort of nilly-willy. All right, so let's use a particular shift and then think about how that is going to affect economic activity. So let me erase some of these things here real quick. All right, so let's do a shift. Let's say that we have an increase in output in the economy with an increase in population, for example. All right. Now all of these generates a movement to the right of money demand. Again, assuming you don't change the level of money in the system, then what's going to happen is your money supply will shift to the right. Sorry, your money demand will shift to the right from, let's call it MD1 to MD2. As the money demand shifts to the right, there is pressure on interest rates to move up through equilibrium forces. In other words, more people and greater output require more money in the system. If we don't change the amount of money in the system, then the price of money has to go up and interest rates will increase. All right. Let's generate a different change. Well, that erased everything, didn't it? All right. No, wait. Did this wrong. We got to put this line nice and straight. All right, so again, let's say we're here at equilibrium 1. All right, now let's take this away and say that instead of doing this, imagine that the Fed wants interest rates to go down. So they want interest rates to drop. All right, now notice that because they have the ability to move money supply, then all they need to do is they need to make sure that whatever money demand is doing, we make these interest rates go down. Now, how do we do that? Well, the Federal Reserve has to figure out ways to make money supply shift to the right. Now, the ways they make money supply shift to the right is by engaging on what we call expansionary monetary policy, and they shift the money supply to the right through expansionary monetary policy. When the money supply shifts to the right, slowly but surely, or maybe sometimes pretty quickly, interest rates will drop in the economy. All right, so if the Fed wants interest rates to go down, what they need to basically do is they gotta flood the system with money. If instead the Fed wants interest rates to go up, so the Fed says, I want interest rates to go up, then they gotta do the opposite of this, and they gotta take the money out of the system. They gotta move money supply to the left. When they move money supply to the left, then through market forces, interest rates will move up. Okay, so if the Fed wants interest rates to go down, they make the money supply shift to the right, and eventually equilibrium interest rates go down. If the Fed wants interest rates to go up, then they make the money supply shift to the left, and eventually equilibrium rates, interest rates, go up. And those are the basics of monetary policy. All right, I already all right, so how does that affect economic activity? Well, it affects economic activity because we use a lot of credit to buy a lot of things, especially things that you cannot purchase right away. So as a consumer, when you're going to buy something expensive, you normally tend to use credit instead of buying it cash. As a consequence of that, when there is a decrease in the level of interest rates, economic activity picks up. And when there's an increase in interest rates, economic activity slows down. So every time interest rates go up, you're going to see a slowdown in consumption, a slowdown in investment, and a slowdown in net exports. Every time you see interest rates go down, you're going to notice an increase in consumption because it's cheaper to borrow. You're going to notice an increasing investment, and you're going to notice an increase in net exports. All right. Now, of course, when interest rates go up and this happens, then eventually the aggregate demand will shift to the left, creating a change in real GDP. And when interest rates go down and this happens, the aggregate demand will shift to the right. creating a change in real GDP. All right. Now, if you remember from the previous chapter, the Federal Reserve has three basic tools of monetary policy. They have what we call open market operations. They can change the level of the discount rate, and they can change the reserve requirement, which then changes the money multiplier. So let's go over the ways in which you use monetary policy. And by the way, this is usually the largest portion of economic professor's test because we want you to understand the behavior of monetary policy and how that affects economic activity. So the Federal Reserve can change monetary policy to either expand or contract the economy. Expansionary monetary policy is used when the economy is in recession and unemployment is going up or it's already high. We call it quantitative easing or QE. Now, in order to conduct quantitative easing, the Federal Reserve does three things to their monetary policy tools. One, they increase the money supply by doing what we call open market operation purchases. They decrease the discount rate and they decrease the reserve ratio. So, during a recession, the Fed will conduct expansionary monetary policy. Expansionary monetary policy is also known as quantitative easing. So they take their tool number one and they do what we call open market operation purchases. Now these open market operation purchases, what basically do is they will buy in the open market treasury bills, also known as government debt. Because they're buying these treasury bills, they have to pay with something. So that payment that they do, they basically do it in cash or in reserves. So they are increasing the level of money in the system. So money transfers to the system. Now this money transferring to the system is the same thing as saying the money supply shifts right. Now the second tool of monetary policy is the discount rate. Now a decrease in the discount rate basically is when the Federal Reserve makes loans cheaper for banks. So loans from the Fed become cheaper for banks. As a consequence of that, more banks will borrow from the Fed, and there will be more money available in the system for you and I to borrow. The third tool of monetary policy is to lower the reserve ratio. Now, lowering the reserve ratio allows for a higher money multiplier. Now, a higher money multiplier allows the banks to create more money. All right, so let's talk about what happens in the money market, and let's talk about what happens in the economy. All right, so over here we have interest rates. Over here we have quantity of money. Over here we have real GDP. And here we have prices. Okay, we have money supply here. Money demand. We have our aggregate supply and our aggregate demand. All right. So let's take a look at what's supposed to be happening. That way, let's use the letter Y here. Just makes it easier for me to call this Y1. All right, so all of these expansionary monetary policy, what it basically does is it makes money supply shifts to the right. When the money supply shifts to the right, wow, that's a terrible line, isn't it? All right, let's go with that. So when the money supply shifts to the right, through market forces, you're going to see a decrease in equilibrium, interest rates. We go from money supply 1 to money supply 2. As interest rates decrease, people decide to borrow more money. It becomes cheaper to borrow. When interest rates decrease, it creates an increase in the level of economic activity because, as I mentioned up here, a decrease in the level of interest rates makes consumption go up, investment go up, and net exports go up. So as a consequence of that, it makes our aggregate demand line shift to the right. When our aggregate demand line shifts to the right, what you should expect later on in the future is an increase in the level of economic activity, aka an increase in real GDP from Y1 to Y2, and an increase in inflation in the economy from P1 to P2. All right, and that's basically how expansionary monetary policy creates an increase in real GDP and helps the economy. All right, now let's talk about contractionary monetary policy. Now, why do you need to use contractionary monetary policy? Well, eventually, this policy is going to generate inflation. Inflation is bad for us because if you have too high of an inflation rate, it takes money out of your pocket. In other words, you become less wealthy every time prices go up. As a consequence of that, when the Federal Reserve starts noticing that economic activity is going back to normal and we started to see some inflation, what you're going to notice is that they're going to go back on what they did before. So when we have too much inflation, the Fed is going to conduct contractionary monetary policy, also known as quantitative tightening. So they're going to be doing open market operation sales. They're going to sell treasury bills in the open market, and money transfers out of the system. So the money supply will shift to the left. They increase the discount rate, makes it more expensive for banks. So it becomes more expensive for banks to borrow from the Fed, and they will stop borrowing. They would also increase the reserve ratio, and it allows for a lower money multiplier. So banks can create less money. So basically, our money supply, instead of shifting to the right, will be shifting to the left. When the money supply shifts to the left, the opposite of what we did before starts happening. So we're going to go from this money supply to this one, and you're going to start seeing interest rates move up. As interest rates go up, the economy slows down. So we go from interest rate 1 to interest rate 2. And then when interest rates go up, as I was explaining here, it creates a slowdown in economic activity. That slowdown in economic activity is going to make the aggregate demand shift to the left, and it's going to slow down the economy. So we go from this equilibrium, call it 1, to this equilibrium, call it 2. We go from this y, call it y1, to this y, call it y2. And what it does is it makes inflation go down. So prices drop, and that's what the Fed wanted to do with contractionary monetary policy. So contractionary monetary policy is geared to lower inflation, while expansionary monetary policy is geared to try to increase real GDP. That's why during a recession, you're going to see the Fed trying to expand the economy by pumping money into the system. And then once you are out of that recession, you're going to see the Federal Reserve kind of pull all of that money back. Now, if you go back to our PowerPoint presentation, you will notice that interest rates, this is the federal funds rate, which is the interest rate that the Federal Reserve uses. Notice that that interest rate wiggles up and down. Okay? So every time you see interest rates going down very quickly, then you see that the Fed is basically expecting a recession, or you're already in a recession. All right, so what's happening right now, and what I mean by right now is this class was done in March 26, 2020. So in March 26, 2020, the Federal Reserve is in the process of lowering interest rates very rapidly, which is what you see right here. All right, in this particular year of 2020, the Federal Reserve is now being challenged by this COVID-19 recession. And then what you see here is a real fast decrease in the level of interest rates by the Federal Reserve. Again, the purpose of that real quick decrease in the level of interest rates is to try to stimulate economic activity and move the economy or the aggregate demand to the right through expansionary monetary policy. Not only that, the Federal Reserve has lowered the reserve ratio to basically 0. All right, so the Federal Reserve targets the level of interest rates because they know that interest rates is something that changes your behavior. Let me show you this really cool tool in Excel so you understand how interest rates can really affect the way you think about something. So one of these really cool tools in Excel is something we call the loan amortization table. So imagine, one of the easiest ways to think about this one, by the way, is the housing market. So imagine that you're going to buy a house for $250,000 and you're going to pay an interest rate of, say, 5% over 30 years. All right, now the loan amortization table is going to tell you how much you're going to be paying on that monthly payment on principal and interest. Now, that does not include other expenses that you have when you get a mortgage, like mortgage insurance, homeowners insurance, electricity, which you got to pay for your house, water, etc. Maintenance fee, maybe if you have an association. So this is just principal plus interest. Okay. Now notice that you're borrowing $250,000 at 5%, 30 years, 12 payments. This is your monthly payment at 5%. Now imagine that the Federal Reserve takes that 5% and they drop it down to say 4%. Now notice this number here. This number here is the amount of interest that you're going to be paying on your loan over 30 years. Okay, so your loan is a $250,000 loan, and over 30 years at 5%, you're gonna pay the same amount of money in interest. So your $250,000 house will become a $500,000 house over 30 years if you pay this amount for 30 years. Okay, now imagine that the Federal Reserve drops this number to 4%. Okay, look at this math right here. Look at the monthly payment and look at the drop in amount of interest. Your payment went down by around 100 and something dollars, almost $200. But look at the amount of interest that you saved from the previous number. So we were at 230 and now you're at 180. You save yourself $50,000 in interest payments over 30 years with a drop of 1% on the interest rate. Now, if you imagine that I drop it down to 3%, notice that you save yourself 2% decrease over 30 years. You're going to save yourself $100,000 in interest. And it's basically only $300 a month. But $300 a month times 30 years is a lot of money. So this is the reason why a decrease in the level of interest rates can create an increase in the level of economic activity, because it makes the purchasing of really expensive assets very, very cheap. All right. The Taylor rule is something that was created by a gentleman called John Taylor. And what he wanted to do is he wanted to figure out what exactly does that federal funds rate have to be to maintain a particular level of economic activity. The Taylor rule is a fairly simple formula. You have to basically look for the current inflation rate, add the real equilibrium federal funds rate, then add half of the inflation gap and add half of the output gap. Now, the Taylor rule is not a rule that people follow, it's just the name of it, but it is a way of looking at what the federal funds rate is supposed to be doing when particular situations change in the economy. So basically, every time you see a recession in the economy, you're going to see a decrease in the Taylor rule, which basically means that the federal funds rate should decline. Now, how does the Federal Reserve monitor inflation? Well, the multiple things that they use in order to monitor inflation, they have all these different inflation metrics that they follow. This is an example of inflation following different inflation metrics. Notice that inflation is not one number. It depends on which number you're utilizing, and that's why we have to follow different inflation metrics over time. So the Federal Reserve normally looks at more than one inflation metric. Last time I checked, their favorites are the PCE and the GDP deflator. And of course, the CPI is used by most people out there. All right. If you look at the financial crisis of 2008-2009, the Federal Reserve was extremely active in trying to get the economy back on track. During the current period that this PowerPoint has been made in March, the Federal Reserve is already conducting a lot of these with basically different names. So it's not the same per se, but it's a very similar behavior. The Federal Reserve has already started pumping a lot of money into the economy, and we're in the process of, as of again, this was done in March 26, 2020. So we're in the process of expansionary monetary policy. All right. I hope this helps you understand how fiscal and monetary policy works and how it affects the economy. Have a good one.